Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode we explain one ETF to better understand it and to help you build the skills that you need to analyse ETFs. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you?
I'm good, Bryce. I'm excited for this episode. We are talking about an ETF that is incredibly popular.
Yep.
I think has really captured people's attention of late,
Yes.
and was requested for this episode by James.
Hey guys, big fan of the podcast. I was just hoping if we could do a deep dive on the DHHF ETF. That'd be mad. Thank you.
Well, it's going to be mad, James. Thank you for that.
DHHF, the full name is Betashares Diversified All Growth ETF. So in this episode, we're going to unpack how we would analyze this ETF from its name, from the information we can find on the website. We're going to chat about how we can use it in a portfolio. But then I think quite importantly, we're going to compare it to its highly risky cousin. Well, its riskier cousin that maybe leads it astray, but maybe has a bit more fun along the way.
Yeah.
That is the geared version of this ETF, GHHF.
Yeah, new car just popped up recently in the family, so can't wait to get to that. We'll do that in the second half of this episode. But as always, when we're thinking about ETFs, how to analyze them, we have to start with the name because there's a lot of information that we can get from the name. So we've got Betashares Diversified All Growth ETF. The first thing that we can tell is that the provider or the product issuer is Betashares, one of the larger providers of ETFs here in Australia. We can then see that it's diversified. Now, you can take that in multiple ways, but in this instance, we know that it's diversified across geographies, and we'll unpack that in a moment.
Yeah, well, I think you're right. Diversified can mean multiple countries, or it could mean multiple assets.
Yeah.
So, but we know that it owns lots of different things. The next part of the name, All Growth, then answers that question. All growth in investing circles is really code for all stocks. And so then we know that it's diversified across a number of different stock markets around the world. So Betashares Diversified All Growth, we know it's a globally focused ETF that invests only in stocks.
Yeah, love it. Code equals, growth equals stocks.
Yeah.
And
income equals bonds, often, most of the time.
Or like conservative or something along those lines.
Yeah.
Anyway, we'll figure out that when we get to ETFs that have those in the name. Just a reminder, everything that we go through today, the information is available on the issuer's website. That's Betashares' website. And you can find all of this information as we go through it.
Yeah, and I think it's important to stress that like ETF providers are obligated to share this information, which is why we say go to the issuer's website. Not because we think the marketing spiel is really great and we're just trying to push you there. It's like they have legal obligations to share most of the information we need to analyze ETFs. So whichever ETF you're looking at, that's why we say start at the website. So Bryce, let's start at the Betashares website. And let's start with the purpose of this ETF. What can we learn?
So from their website, they say that it is to provide low-cost exposure to a diversified portfolio with high growth potential. It is an all-in-one investment solution with 100% allocation to shares. It's the one-stop shop.
Yeah, they also say on their website that the ETF provides exposure to approximately 8,000 equity securities or stocks listed on over 60 global exchanges. So as we said, globally diversified. Now the question is, how does it achieve that purpose? What index or benchmark does it try to track? So there's a bit of a quirk with this DHHF. It is an ETF of ETFs. It allows, this structure allows us in one trade to buy a number of underlying positions. And in this case, there's an Aussie ETF, a US ETF, and then two more globally focused ETFs. So we'll get into what they are a bit later, but the structure is, an ETF that then wraps up a number of ETFs.
Yeah. So why would you want that is probably the next question, because you and I talk about, we have 4 or 5 ETFs that we're investing in individually, all listed on the ASX. But the beauty with these products, and there are a number out there as well, we've spoken about VDHG before, it's very similar, is that in one trade, as you said, you're getting access to multiple underlying index funds. And the beauty of that is you don't even then have to pick which ones you want to invest in. You don't have to worry about portfolio construction. You don't have to worry about multiple brokerage costs. We've spoken it about many times before, but I think what we see in the Equity Mates community is so much of our community use this as their core portfolio.
Yeah. And that is completely fine. And you said you don't have to worry about multiple brokerage costs. I think that's particularly important if you're just starting out and you're investing in small dollar amounts, or you're trying to dollar cost average quite regularly and you're investing in small dollar amounts. Like that multiple brokerage buying multiple ETFs can really add up. And so this just allows you to strip it back, one line in your investment brokerage app, just one trade, one set of brokerage. It's simple. And that's really how it's designed to fit in a portfolio as well. Like a simple, all-encompassing core portfolio.
Yeah.
Give you globally diversified access to most of the major stocks around the world and allow you to just keep chipping away at that, keep dollar cost averaging in. And if you are interested in then making investments around it, knowing that you're getting, basically the global stock market average return.
Because it is 100% allocation to stocks as well, Betashares recommend that it is suitable for investors with a time frame of at least 7 years. But a few other things to point out. Fees, they say it's low cost. It's 0.19%. So very competitive on fees.
And that includes the fees of the underlying products as well. It's not like you're paying those fees as well. Like this fee encapsulates
all encompassing, yes. Now, importantly, you want to look at the performance as well. And there's been some pretty strong performance from DHHF. So after fees, as of the 30th of August 2024, the 1 year return has been just over 16%, 3 years at about 7.5%, and since inception back in 2020, it's been doing just over 11%. So there, as you would expect it to do, as Ren said, global stock market return.
Yeah. Now, just to be clear, those are all per year returns.
Per year returns, yes.
It does pay a dividend. The underlying stocks in the ETF pay dividends, and that gets passed through to us as investors. Over the past 12 months, the dividend yield was 2.2%. So not bad.
Yeah.
But you're not investing in it for the dividend yield, let's be honest.
No.
So let's turn to the top holdings. And as we mentioned, it's an ETF of ETFs. So there's 4 ETFs that underlie it.
Yeah. So in terms of geographic allocations, firstly, we've got exposure. 37% of the fund is exposed to Australian equities, and the underlying ETF there is the Betashares Australia A200. Then you've got international exposure. The remaining 63% is split internationally, 40% US, 18% to developed markets, excluding the US, and then 6.3% to emerging markets. So to give you those exposures, you've got the Vanguard Total Stock Market ETF, which is your US stock market. Then you've got the SPDR Portfolio Developed World X US ETF listed on the New York Stock Exchange. And then the SPDR Portfolio Emerging Markets ETF, also listed over in America.
So 2 big takeaways from that. First of all, full credit to Betashares, not just stuffing this ETF with their own underlying products.
Absolutely.
They've got A200, which is a Betashares product, but they've got Vanguard and SPDR in there.
Yeah.
So I think that's full credit where credit's due. Also, the fact that they've gone for US ETFs rather than Aussie ETFs.
Yeah, as in US listed.
Yeah.
Yes. Yeah. It is interesting, but that kind of show or demonstrates how the underlying ETFs are made up, and the aim that Betashares then actually manage this to ensure that those percentage weightings stay in that range. They don't let it, they don't let emerging markets run to 50% of the portfolio, or that's why for a long-term position you don't actually have to worry about any of that. Betashares do that all for you.
Yeah, and this is fundamentally how products like DHHF and VDHG are different to products like, VGS, which is like an international index fund. VGS would just take every stock in the developed markets and say, we're going to weight them by market cap, and then we're going to just, we're doing like a full global index. Whereas DHHF and VDHG put their finger on the scale a little bit and say, even though Australia is only 2% of the global stock market, we're going to upweight it and make it like, 35, 37% of the portfolio. So when you are making those decisions about, there's no right or wrong answer there. Like, they're both great products, but there is a difference in how they're constructed.
Yeah.
Yeah.
Pre-made or predetermined portfolio construction. Now, Ren, at the top of the episode, you introduced I don't think you said spicy cousin. I can't remember.
No, I said that risky cousin.
Risky cousin,
This is the
that's
cousin
it.
that like comes to family gatherings and smokes a
Turns
cigarette
it
out
up.
the front, and all the other cousins like a little bit intimidated, but also look up to this
That's
ETF.
right. All right, well, we'll kill that metaphor, Ren. We're actually talking about GHHF, which is the Betashares Wealth Builder Diversified All Growth Geared Complex ETF.
Yes.
Woo!
No prizes for the naming conventions. Well, I guess there's regulations around what they have to call it.
Yeah.
But they're certainly not winning any marketing awards for the name there. But they are certainly maybe winning some marketing awards for how this ETF has launched. It only came to market this year in 2024. I think April it launched. And it certainly made a splash. So let's quickly just cover off what a geared ETF is if people are new to that concept.
Easy. So a geared ETF, effectively, in this instance, Betashares is going to the bank and borrowing money and giving you increased exposure to the underlying assets, because not only are you investing, but they're also increasing the leverage within the fund and giving you increased exposure. So in this instance, they say that the geared ETF is 30 to 40%. Now, what this essentially means is if I were to invest $1,000 into the fund, Betashares then go out and borrow an additional $400. That's the 40%. So I get a total exposure of $1,400. And that is great on the upside because I've got more exposure to the underlying assets, but it also applies to the downside because I have more exposure on the downside.
Yeah, and the effect of this is that the movements up and down of the ETF are amplified. So, a 1% move up, in theory, should be like a 1.4% move up for investors in this geared version of the fund. And over time, in theory, there should be a performance difference between the two.
Yeah. So in this instance, the Diversified All Growth Geared Complex ETF, they specifically say that it's geared to the loan to value ratio, or LVR, of 30 to 40%. So what this means is, based on how much people are investing into this ETF, Betashares are going to manage the additional gearing to the tune of 30 to 40%, and it'll always be within that range.
Now, there is one other difference that comes with this, which is your fees.
That's right. So fees are almost double. We spoke about 0.19% for the non-geared, whereas GHHF is 0.35%. Now, obviously, this is because it costs Betashares to borrow money and it costs them to administer this. So yes, you are hopefully getting upside with the gearing, but you also are going to pay a little bit more for it.
So let's put this into practice. Over the past 3 months, DHHF, the non-geared version, has returned 4.5%. GHHF, the geared version, has returned 6.95%.
Which is essentially what it's supposed to do.
Yeah. So it's working as intended.
Yeah. Since inception, well, as you said, it's only been around since April, so 11.45%.
But that does lead to this question we got from Cameron.
Hey, equity mates. Quick question. I'm currently a DHHF dollar cost averager, but I've noticed GHHF and looking to get some more benefits from that and from the leverage. In the last couple of trading days, though, I've noticed that the volatility has actually been less. Can you guys explain why? And would you start GHHF over DHHF? Thanks, guys.
So it's a good question from Cameron, and one that gets slightly technical, but hopefully people stick with us here. So the way these ETFs work is that every quarter they get rebalanced and reset. And so at the start of the quarter, the asset allocations in GHHF and DHHF will be the same. The percentage weighting to Australia will be the same, to the US will be the same, etc., etc. But then over the quarter, because they're leveraged, they'll move slightly differently to the non-leveraged version. And so by the time you're looking at this, Cameron asked this question about 2.5 months into the quarter, the asset allocations have drifted slightly apart. And so in DHHF's case, at the time that Cameron asked this question, Aussie equities were 37% of the portfolio, and in the geared version, Aussie equities were 36% of the portfolio. Similarly, US equities were above 40% in one and were still at 39% in another. So just because of the way that the two products move slightly differently, because one's leveraged and one doesn't, that affects the asset allocation percentages, and then that affects how things move day to day. But the good news is for investors is that every quarter there's a reset and there's a rebalance, and then the process starts all over again.
Nice.
Does that...
Yeah, that makes sense. Yeah. I think importantly with these products, and it kind of ties into the last question that we always try and answer here if we're doing head on head, which would we be picking and whatnot. I think it's important that you really understand how these products work, because not all leveraged ETFs are the same underneath, and that you understand why you have it in your portfolio and for what period of time, just like any ETF. But you can get caught out thinking that the headline here is they're going to gear it to 40% and your returns are just going to be multiplied by 1.4 or whatever it means. That's not the case. It doesn't actually translate like that over a long period of time. So just be wary of why you're doing it.
I think leveraged ETFs, I think generally as a rule of thumb, without going too deep down the rabbit hole, leveraged ETFs work really well when the market's trending up. They work really poorly when the market's trending down. They also work really poorly when the market is just trading sideways and is quite choppy, because each pronounced move down, you need a more outsized return just to get back to zero. So there's more content on that on Equity Mates. You actually did a big study on that last year that made me sell all my geared ETFs and go back to non-leveraged ETFs. And I think my final point on it all is, whilst leverage can be interesting, whilst the cousin smoking out the front can be exciting and risky, it's unnecessary. You don't need it. And that's probably my final thought.
I'm on the other side of the fence. I can't say that because I have 2 geared ETFs in my portfolio.
Yeah, okay.
But I agree with you you're right, over the long term, if the market is just steadily trending up, they're great. But in times of volatility and on the downside, you really need to be prepared for what can come in your portfolio. So
yeah. Now, if you want more on this, we'll pull out the episode where you shared the findings on Equity Mates Investing Podcast, and we'll include that link in the show notes. So if you want to go deeper on leveraged ETFs, the benefits and the perils, and you want to hear Bryce spitting some very interesting knowledge, have a look in the show notes.
Yeah, it was actually done at a time when the market was downtrending and quite volatile. So it's definitely worth a listen.
Yeah.
So if you have an ETF that you would like us to cover, we'd love to hear from you. If you're watching on YouTube, leave a comment and we will make sure we put it on the list. Otherwise, you can send us a voicemail just like our listeners have today. We would love to hear from you. Ren, we'll leave it there. Pick it up next week.
Sounds good.